What's up, you guys? I'm Dan, this is Frugal Not Cheap, and today we'll go over my horrible track record with speculative trading. So if you've watched my channel for any length of time, you can tell that I'm an advocate of boring index fund investing, just having a diversified portfolio, coming up with your asset allocations, holding that over a long term, not really trying to gamble on individual stocks, and definitely not any kind of speculative trading. Now, that doesn't mean that I haven't ever tried my hand at it, and I did do this a while back just to see how I would do. At my job, I'm involved in commodity trading and specifically with options and futures and swaps. And of course, I couldn't trade any of the assets that I trade for work, right? That would absolutely not be okay. So I had to find some stuff outside of that to trade. So this was way back in early 2014. I thought I'd give it a try, and I learned a little bit about technical analysis and about risk management and trading. And so I thought I'd give it a shot. So I bought a few shares of a ETF that tracks the Dow Jones Industrial Average. I think it was DIA, but I'm not 100% sure. In any case, I bought in at $99.92 in February of 2014, so that was about 9 years ago. And at that time, commission-free trades were really not common. This is well before Robinhood, so I had to pay $6.95 each side, or about $14 a round turn. But directionally, I was right on this trade, and the price rose to $111.78. So this provided, after commissions, a 7.07% gain, which was pretty good for 1 month's time. The actual dollar amount was very, very small. This is just $21.68, because my initial investment was only $306.71. Still though, a 7% return in a short amount of time. Of course, that emboldened me to try again. The next good opportunity that I saw based on technical indicators was in August of the same year. This time I made a more sizable bet, emboldened again by my early success. I bought 52 shares at $113.54, and I got stopped out a week later on August 20th at $118.31. After commissions, this was just under a 4% gain, and since I'd made a much larger investment of $5,911, this resulted in a gain of $234. So that was pretty good for the first two trades, right? But of course, past performance does not guarantee future success. Not long after that, indicators started to look a bit overbought, and so I thought that things were going to be turning south, and I bought 249 shares of an ETF that is the inverse of the Dow, called SDOW. I bought in at $24.99, and I was wrong about this, and I got stopped out at $24.66. So this resulted in a 1.5% loss, but in terms of dollars, my track record looks worse now because I lost $96 on this one. So of course, if I'd invested the same amount on all of these trades, then it would have been a pretty decent result, but because my position size increased as the return started getting worse in the negative, then I ended up only $160. Now, one thing I mentioned is, of course, risk management and getting stopped out. And so this is probably a good opportunity to talk about a pretty basic principle here, is that it's a good idea, I believe, to try to limit one's losses and not try to limit one's gains. So a lot of times people talk about selling at a certain price. That doesn't make any sense to me, because we can just put a stop loss, a trailing stop loss, that's going to follow us up, at a trailing to the market price as we go up. And then if we're wrong at some point, market falls, hits the stop loss, we sell out. Now, of course, this assumes, a lot of things like good liquidity, the certain narrowness in the spreads. If the spreads are too wide, it can be a problem, that kind of thing. Anyway, so for all these trades, what I would do is I would, put a stop loss on to make sure that I could limit my losses and then let those gains run. And so in this case, because directionally I was wrong, then we did hit that stop loss, and I was able to limit that loss. So for a while there, I just, got kind of a sour taste in my mouth from having that loss, and just didn't see any great opportunities. But a couple years later, in 2016, I decided to take another stab at things. This time I bought a leveraged ETF on the Dow Jones Industrial Average in a positive direction. This time I think it was leveraged 2x. So in January of 2016, I took a position of 35 shares at $58.12, and I was stopped out over a month later on February the 18th at $57. So this resulted in a loss of 2.6%, and now I was mean, I was, I was batting 500. So I'd made a gain on the first 2 trades and then lost on the subsequent 2 trades. Again, due to risk management, it wasn't so bad. Overall, I was still up $106. But one thing I do want to point out here is that these leveraged ETFs are not meant to be held for a long period of time because they start to decouple from the performance of the underlying. They're really meant only to do 2x the performance of that index on a given day, not over a long period of time. So at that point, I really decided that, I'm not the most amazing trader in the world. I should probably give this up. And so I did. And it wasn't until very recently that I saw an opportunity that just looked, too juicy not to gamble on and have a little fun. And again, I should mention, look, the amounts that we're talking about here, some of the trades were relatively large, but the amount at risk was still a relatively small portion of my portfolio. Definitely not something, we're not YOLOing here at all. Anyway, so on March the 13th of this year, I'd noticed that Schwab stock had really tanked. I think the loss was like 60% or something like that. And I figured, look, these fears can't last forever. This thing should probably bounce back. Why don't I take a little gamble and put a position on? So I bought 20 shares of Schwab at 48.32, and I got stopped out just 4 days later at 54.28. And that was a pretty handy gain of 12.3%. But at that time, actually, even though I got stopped out, I still believed in the trade. And I thought, heck with it, let's just take a risk and we'll buy some call options, which of course is risky because the thing with options is you've got to be right about 2 things. You've got to be right about the movement in the underlying. So with the call options, you're betting the price is going to go up. You also have to be right about the timing. So the price has to go up within the period of time before your option expires. And then also throughout that time, in kind of a, whatever this shape is, there's an exponential curve to it, there's a decay to that time value. So if you start getting near the end, then your time value starts to decay at a very rapid rate near expiration. And so you lose a lot of value that way as well. Anyway, I bought 100 shares at $5 on the $54 call options on Schwab expiring April the 14th. I got stopped out the same day. Options can be pretty volatile at $6.30. And this resulted in a really sweet 25.7% gain. So you can imagine I was feeling pretty good about myself at this point. And what I should have done at that point is to quit playing. But the major problem is that I still see and do continue to see Schwab as being undervalued. Now, I haven't done a huge deep dive. There may be a lot of things I don't know, but 60% drop in what seems to be a pretty strong company. So the following week on March the 20th, I thought, hey, prices have fallen back down. Why don't we take another bet on this and just try to grab a little bit more? And so, yeah, I got greedy. And not only that, but I increased my position size and put much more value at risk. So with call options, I know that my risk is limited to my investment because I could just not exercise the option and that's the end of it. I lose whatever the initial premium is. So at least that part's good. But because I tripled my position size, I was now risking $1,172 instead of $501. And this time it was also a higher strike price. The market had moved up a little bit, so chances were even worse there. I really didn't feel all that confident about this trade, but I thought, heck, let's just go for it. And this time I also made the other mistake. So one, I wasn't all that confident about it, and I wasn't really managing, risk all that much, like position size I wasn't thinking about properly. But the big one is I did not put a stop loss. In fact, had I put my stop loss on, there was a moment, I remember the initial day, where I would have gotten stopped out and I would have said, all right, I was wrong about this trade, let's get out. But instead, I took the stop loss off and thought I would write it out. And I really thought, between this date of March 20th through April the 14th, the stock has got to come back at some point. And I was absolutely wrong about that. I was so wrong that I ended up just liquidating the position manually at one point just to get something back, which is all of $16.02 after fees. So on this, after, not a terrible track record of trading before that, I ended up losing 98.6%. And, so of course this more than wiped out any of the previous gains that I've had. And so overall to date, I've lost over $800 in speculative trading. So again, it's not a gigantic amount, but, it's not inconsequential either, that 800 bucks. I don't know that I got $800 of entertainment value out of this. Most of it was due to the mistakes that I just made with this last trade. So am I done with speculative trading? Well, I won't say 100% yes, because It's kind of fun, and I might see a really good opportunity at some point, and I learned some lessons this time as well, or relearned some lessons that I already knew. But again, this is going to be an incredibly small part of my investing activity, like just tiny compared to everything else which I do, which is just dollar cost averaging, according to my investment policy statement, just doing exactly what I've always said that I'm going to do, on and on every week by week. That stuff is not nearly as exciting compared to this stuff, but as we can see, long run tends to generate a much better result. So I hope you found today's video helpful and entertaining. If you did, please hit the like button and consider subscribing. Thank you very much for watching, and I will see you in the next video.